Investing in stocks can be quite overwhelming. We are bombarded with countless information, numbers, financial statements, formulas, strategies, news, etc., which for a beginner investor would have a hard time processing all of it. In turn, most rely on speculation alone rather than taking the time to study the basics first. The stock market, instead of being a vehicle to grow your money, becomes a large gambling machine. That's why it's good to have a guide to follow, especially when buying stocks. And this is where the intrinsic value formula comes in. With a guide in buying stocks may prevent you from buying an overly priced company. Just think about it. If the company is worth 10 billion, why would we pay 20 billion for it? As a value investor, we want to get it at a discount. You knowing the intrinsic value of a company lets you filter out the overvalued and the undervalued ones. But there is a catch to it as well. This isn't some magic formula that will assure you good returns. There's no such thing that exists that is 100% accurate because we don't know if the company would stay the same in the upcoming years. And when computing for the intrinsic value, we are merely projecting what the company's future value would be. That's why before you start calculating, you need to know first the company. Are its financials good? Is the company handling its debts well? Are the leaders competent? That's why in my checklist, I always put the intrinsic value calculation last. If it does not pass the first lines in my checklist, then I wouldn't even waste my time calculating it. Because since we are merely projecting, or you can call it a smart guess, then we might as well boost our chance to assess if the company is really worth investing in or not. That's why we have to combine this with other valuation methods as well to determine if there is a high chance the company will continue to grow well in the future. Just take the quote of Warren Buffett. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So it doesn't mean that it is undervalued based on the formula you'll be investing in it. No, you have to know if the company is a wonderful company to begin with. Just like when buying a gadget, it doesn't mean that it's selling at a low price, it's a better one. You have to know first if it can run well, its specs, everything. This is the same for stocks, so never use this as a sole metric to determine your investments. Now there are a lot of formulas out there you can use, like the DCF formula or Peter Lynch dividend-based formula. But today, what I'll show you is a formula based on price to earnings and earnings growth. Some call it the financial metric-based formula, but the name isn't important. This is a widely used formula for a reason, because it's really easy to do. This is also the one I use and I've been using it for the past 3 years, and it has given me good results so far. And you don't need paid websites to get all the data. It is freely available, although some paid websites can help you get it a lot faster. Now I've already made a video about this back then, but since most of the websites I've shown there have changed their platform, so I'll be sharing with you other ways to get it. But if you want a step-by-step way to make it in an Excel sheet, then do watch that video as well. Now in this formula, we will be computing for the future intrinsic value, the present intrinsic value based on our computed future value, and the buy price. I'll be explaining this formula as we go on ahead in the video. Now the things you need for this formula is, first the EPS, next the 5-year high and low of the PE ratio to get the average PE, and growth rate. For the earnings per share, it's easy to get. You can head down to investing.com or MSN Money, go to the overview section of the company you will research. There's the EPS available for you, although there are some differences sometimes in different platforms, but it's still close and won't affect your computation that much. And you can also see the EPS in the financial statements itself. You can go to the income statement and below is the diluted EPS excluding extraordinary items. The same for MSN but gives you up to 8 years worth of data, which will be useful later on. Next is the 5-year high and low PE ratio. Now although MSN Money has updated its platform and only shows a 3-year average PE ratio in the analysis section, well, they still have a graph beside it that shows more than 7 years of history of the PE ratio. With this, you can easily get the highest and the lowest years. So for our example, Globe, just click price to earnings, then get the highest, which is 2021 at 19.60 and the lowest was in 2019 at 12.69. So we can see that investors are buying Globe at this price range relative to its earnings in the past 5 years. Now, what if the company you're searching for doesn't have this graph available? Well, there's still a way for that, but takes a bit of work. By doing this, we would still get almost the same result as what MSN is showing us in their graph. So go to the 5 years range for the price chart of the company. Take note of the price every end of the year. So we start at 2018, 1,880, 2019, 1,990, 2020, 1,997, 2021, 3,265, and 2022, 2,189. Now you don't need to be so precise. Then after you've noted all prices, go to the financial statements. Let's use MSN Money since they have 8 years worth of data. Then get the EPS for 2018 up to 2022. Now for 2022, since we don't have yet the EPS for it, you can use the current EPS of 232.48. So now that we have noted all that down, the formula of PE ratio is simply price divided by earnings. So if we do this for the price we got in the chart and divide it to their corresponding EPS for that year, 2018 14.11, 2019 12.49, 2020 15.14, 2021 19.26, and 2022 9.41. So if we compare our data with MSN, we almost have the same numbers. Mine's just a little bit lower. So this is the manual way to get the 5-year high and low of the PE ratio. So let's use my data for now. Our highest is 19.26 and the lowest is 9.41. With this, we have an average PE ratio of 14.33. Now the last data we need is the growth rate. Now this is where a lot of investors differ. I've read in the book of Philtown rule number 1, he uses past equity growth as his growth rate. Although his formula also uses PE and earnings, he said in his book, the single most important number for choosing a business's estimated future EPS growth rate is its past equity growth rate. He explained, because the history of growing equity shows that the business has been able to create more and more surplus cash each year. But he also noted, we still have to review all our growth rates to find the best number for the estimated EPS growth rate. So we still need to check look at net income past growth rate. This to compare the best percentage to use that the company can really accomplish or do. That's why this is where things differ from investor to investor. Like for me, what I usually use is a 10-year compounded net income growth rate. For Globe's case, it's at 15.90%, which is quite high, and I don't think the company would be able to accomplish this for the next 10 years. And their 10-year compounded equity growth rate is high as well, 13.98%. So for me to be conservative, I just put in a 10% growth rate for Globe. That's why you have to use your intuition as well. Don't just type in the numbers just because the EPS growth is like this or the equity growth is like this. You have to assess as well if the company can really keep up with the growth rate. As for what I use, if Globe continues to grow their earnings by 15%, or if they grow like how their equity grown by 13.98%, then good for me. But if they miss it by a bit, it's still within what I projected. That's why I always go for a more conservative growth percentage, so I usually just round it off to the lowest range. That's why this is the part where biases and favoritism goes in. Some investors put in a large percentage. This increases our buy price, so to avoid that, I go for a more conservative growth percentage. Now back then I used ROE, but I stopped using it because it can be influenced by debt, which can increase drastically their percentage. Now I also don't use the normal average growth rate because there are some years wherein companies have a sudden jump in growth. For example, in Globe's case in 2014, they had a massive 169% growth. So if I use a normal average of all of this, I would get a huge percentage, which isn't realistic. And in some years there's a decrease and a sudden increase after that. So compounded growth rate for me is better because it gives you the real growth of the company in a given time frame. Now computing for the compounded growth is easy. Let's use my 10-year equity graph for Globe. Now book value per share is the same as equity, it's just on a per share basis. Their 10-year annualized or compounded growth is 13.98%. To get this, you just need to get 2013, which is 246.46, and for 2022, I only have the latest 12 months, so let's use that, 912.42. This is a 10-year range. Now we go to calculator.net. They automatically compute annualized returns for you or compounded growth, and you would get 13.98% if you type in the data you have. You can also use Excel for this. By using the formula rate, get the two numbers you have and type in this formula. The one with the minus is the starting year, so just put in the corresponding cells you use and you will get the same result. But just use the website, it's easy enough to do. But if you only have 8 years worth of data like in MSN, they show 8 years of shareholders' equity, so just change the investment length to 8 years. MSN I think is the only free platform that has up to 8 years, so if you use the Excel formula, you just use 8 rather than 10. So now that we have all the data, we use this formula to get a future intrinsic value. We are projecting what a company will be worth 10 years from now, which I got is 8,643.91. This is assuming Globe continues to grow at a rate of 10%. So if you use only 8 years worth of data, just change the power of 10 to 8. Now since we have the future value, then we need to compute what we will buy the company at the present time. This is a present intrinsic value. So again, if you only use 8 years, then just change 10 to 8. Now the 1.10 in the formula is the discount rate we want. The 0.10 is the 10% annual historical compounded returns of the market. So if you want a higher return than the market, then use a higher discount rate, let's say 15%. You type 1.15, but this gives you a very low present intrinsic value, which is not bad, but I always just go for the 10% historical compounded returns of the market. It's up to you. With this, we now have our estimated present intrinsic value of the company, but there's one more thing we need to add, and that is margin of safety. Since we as an investor accepts that we are merely projecting or guessing that the company will grow to this amount, there may be some errors in our calculation, our growth projection may be off, or our discount rate is too high or low, then we might as well leave some cushion to ourselves for those errors. That's where the margin of safety comes in. For me, I always use a 30% margin of safety, so I take 30% off from the present intrinsic value, and this gives me my buy price. It's all up to you. Some investors use 50% MOS, and some veteran investors, since they are really confident in their projections, use a smaller MOS, even up to 10% only. But for me, I always go in the middle, so 30% is what I use. So with this, my computed value for Globe is 2,332. This is quite different from my previous video of Globe of 2,400 because of the difference in the high and low PE, but it's just a tiny bit. So if you look at Globe's stock price as of the creation of this video, it's at 1,990. As for my computation, Globe is trading 14% below my buy below price. Now as I said, this shouldn't be used as a sole metric, it still has to pass your checklist first. Good financials, well-handled debt, and you can even compare their other price metrics as well in the companies in the same industry. If you compare their PE ratio, Globe is in the middle of Converge and PLDT, and the price to book is only 2.2 compared to PLDT which has 2.3 and Converge 3.4. So by comparing their competitors, we can see Globe is relatively undervalued compared to its peers. By the way, this data is from Simply Wall Street. If you want to sign up, you can use my link below. They offer a forever free basic plan, and if you do avail of their paid plan using my link, you can get 30 and even up to 40% discount. So anyway, these are just some examples of combining your intrinsic value computation to check if your projection is somewhat correct. So this ends this video. I hope you've learned something, and if you did, I would appreciate it if you show your support by clicking the like button. Thank you, and see you in the next video.